Hey traders, Nick Shaheen here looking at Canopy, but today's video is about something else. So stay with me. I'm going to start in Canopy and end up somewhere else. So I believe last time I did the video for Canopy was somewhere here, early July. Stock was falling. I said it's okay to catch a falling knife. I made a couple of points in the video, and I'm going to springboard from that into the new trade setup. So, by the way, this is not a trade recommendation. It's not a trade alert. It's me thinking out loud and sharing what I know about charts, and suggesting a new way of looking at how to invest when I'm unsure about things. So stick with me until the end. All right. So at the time I said the first point I made is that okay, it's a catchable dip, provided A, the market holds up, and B, I'm diligent with my stops. So if it's a trade, I said I would stop out here. I pointed at this one, or here, and I pointed at that one. Those were my exact words: stop out here or here. You can go back and look at it. Because I said if this is lost because of this, we have no clue how deep they're going to go, and it could be really scary. And then I said, okay, I'm not going to even talk about it. Even if we give them credit for only half of the pop, on the downside, it would put us somewhere around the $11. And I said, I know at the time up here, this seems impossible. I said, think outside the box, because stuff happens and stocks fall for whatever reason. This is Wall Street. They're not fair. They cheat, they scratch, and they're out to screw everybody. If you make the assumption that the market is out to screw everybody, then you would always be on your toes and never say things like, oh, you'll never be there. Okay, because we don't know what set of circumstances could take us somewhere. So always be open to it. And I was positive on the stock. I wasn't ragging on it. I said, yeah, it's a catchable dip, but I would stop out here or here and re-engage lower. All right. And I said I would be, and this is the second point, I would be confident catching the falling knife on the way down. I said 20 and lower, it would start to get interesting, because I banked on these guys holding their own. And they did for a little bit, about a month, and then they lost it. They lost these levels, and then they set on to finish this breakdown. Okay, so how do I catch a falling knife now, and why? Well, here's the switch. I would use Tilray. Why? Because look at it. It's a better performing chart. And theoretically, I'm going to share with you why fundamentally, as little as I know about pot stocks, I'm going to share my logic, and you can agree or disagree in the comment section. I welcome the comments as long as you're civil about it. Some stocks, this is not one of them, as soon as you say anything that is misconstrued, boom, your face looks like ass, or something like that. They go straight to the personal insults. Please, there's no need. So this is CGC. Look at it. It's making a descending trend. That's clear. They both are doing that. But look how it is relative to, say, this period of time. October. Let me go back. September. Yeah, it's below it. So if I go to Tilray, it's still holding its own. And I do have one point, this one, very sharp point. And they failed. They took their time. They got here. They thought about it for a few days and then took off like a rocket. They successfully defended it several times, and now they're back a little bit lower than I'd like them to be, but they're still at it. So they're fighting the good fight. Relatively speaking to its own self, it's behaving better as a stock. Not companies, stock. There's still a gap here, so it could still fill it or not fill it. So if I were to say, okay, this is a catchable knife, I want to choose Tilray over CGC. Personal preference, just from the chart itself. I will immediately penalize myself with conviction, because we don't know what we don't know. This set of circumstances in the world has never happened before. The COVID, the trillions of dollars, we've never seen this before. So whatever conviction I have, if it's great, I say, you know what, it's not so good. What does that mean? It means I take small bites. If I usually buy 100 shares, I'll buy 40 or 50. I'll add later. Okay, so there's no need to pile in. All right, so I'll tell you why fundamentally I like this one better than the other one. So you remember the olden days when anybody wanted to go long pot, they said CGC because it has a bulletproof balance sheet. They had a $4.5 billion advantage, cash infusion from the part buyout from STZ, Constellation brands. They bought 30, 35, whatever it is, percentage, and so they handed them cash. What did they do with it? Maybe they did something fantastic, maybe not, but they're not crushing the competition. Tilray now is the second biggest, or one of the top two, I think. The old-fashioned way. They went out and bought somebody they did a lot more with far less. That's my impression. So logically speaking, I'm not an expert in the pot stock. You may be, as I said. Educate me. I can tell you one thing. So when they first burst onto the scene, pot stocks, the valuation was crazy. And I'm not talking like PE, because they're growth companies. We don't talk PEs, we talk price to sales, because that's what matters. They need to overspend in order to grow sales. And these guys are doing it illegally. They have to. They're federally illegal. So they're swimming upstream is what I'm saying. And so whatever they did, all of them, they're doing great, because it's amazing the hoops they have to jump through. Even just simple banking used to be, you have to pile in the cash. So anyway, you can't do buyouts across states, I don't think. There's probably some RICO law against it. So total revenues went from 20 to 40 to 170 to 500, and then boom, back to 200. COVID. So I'll give them a pass. They're in the process of repairing. But what's really impressive is the price to sales. It was through the roof. I remember when pot stocks came on board first and they went crazy. They had like $2 million in sales, $3 million, and their valuations like 7, 8, 9, $10 billion. I can't remember the exact numbers, but it was like 200, 300 times sales. It was just ridiculous. Well, these guys got their crap together. This is like slightly above Apple, and Apple's a mature company. This one is a growth company. So they're doing a lot with very little. And the owner of the stock, so if I'm buying the company today, I'm only giving them 10 times less, 9 times their total sales. Okay, so on a depressed year. So this is pretty cheap if I expect growth to continue. So that's why I'm saying it's not a bad thesis to buy and hold for the long term. Old school. Let them establish the business, the industry. These are trek companies, trekkers. I mean, they're plowing the fields. So what they need is the legalization headline from the U.S. federal government. When Biden was leading in the polls, all of these concepts took off. And now it's time to just put up and just do it. Luckily, I didn't chase it up here. That was freaking insane. That was part Biden, new presidential candidate winning, part GME, part everything. And this was the original. Okay, if you forget that, check this out. If you weren't trading a while back, this is the original super spiker. That was 2018. I was trading it. I sold puts, and the move was so violent that I couldn't even close my winnings. Sold put, that's a bullish trade. Nice transition there. Stick with me with that concept. And then it rallied. So I won. I went to go close my position. I couldn't. That's how violent it was. I had to let go of a lot of my profits to close my position. It became hard to borrow and all kinds of margin requirements, and it was just a mess. I enjoyed it because I was winning, but I can imagine that somebody who was shorted suffered tremendously. Look at that. That's pretty freaking painful. I don't think they will ever get back there, and if they do, it's going to take a decade or two. This spike, look how small it looks compared to what it did back then in 2018. So GME did not invent these super spikes. Okay, so the plan is, if I usually buy 100 shares, I would buy part of that. Leave room to add later. If the markets crash, I'll probably be able to buy it in the single digits. What? Hey, I'm just telling you, I'm bullish on it. And if I mention single digits, I'm being open-minded. We don't know what we don't know. All right, so I'm going to introduce you to a new way of trading and then leave you hanging. And again, this is not a recommendation. So if you're not open to options and you think options are dangerous, I'm going to prove to you how this is a false statement. They can be dangerous, but if you use them smartly, they're super great. And this is an example. You want to buy shares right now, and I want to be bullish. And I don't want to buy shares right now, but I'd rather buy them at $10. Okay, so let's do it. I'll go to a trading platform, and I'll say, okay, for this year, I would love to buy it at $10. You say, I'd like to buy it now. So let's pay, I'm going to round to make it easy numbers. So if you pay the going rate for the stock right now, and instead of, so money leaves your account, I get bullish by selling a put. I collect money for it. No money leaves my account. The price falls to $9. You're down 18%. I'm rounding 15% if you want. I haven't even lost a penny yet, because if I get put the stock and they shove it down my throat at $10 like I said I would, I collected $1 to open, $100 in this case, then my break-even point is 9. So the stock drops to 9, you lose money, I don't. How is that more risky? No money left my account this whole trip until I get put the stock. Then I buy the shares just like you did. So if somebody buys a share right now or somebody sells a put right now, they're both bullish the stock. One forks over the money to own the stock from here, from now, no buffer. Starts falling, they start losing money. Somebody sells the put to be long, stock falls, that put position loses money, but I don't care. As soon as they give me the shares, that money, the paper losses disappear, and then I'm long the shares. My break-even point is 9. I have to buy it at 10. So if it falls to 8, I'm losing $1. You're down 30%. I'm only lost $1. So I'm in better shape still. So it goes to 0. You lost 11 and change. I lost 9 because I didn't get long until 10. I collected $1, so my break-even point is 9. I'm on the hook from 9 on down for losses. You're on the hook from right now. So selling puts, that's one scenario where options are most definitely 100% proof positive, safer than risking money the traditional way. Again, this is not a trade recommendation because there are a whole bunch of nuances in between here and there because of earnings reports coming up or whatever. So don't come to me and say, oh, I did this trade you recommended. I did not recommend this trade. This is me showing how somebody can get long a stock using options and be safer than forking over the money up front for it. All right, folks. Happy 9/22. This is Fed Day. Was Fed Day. It was a pretty exciting day. If you like this video, hit like. If you don't subscribe to this channel, subscribe to it. It's free. For now.